All right, so it's been 3 days since the military strikes on Iran, and the markets are, well, they're walking a tightrope. We're getting some seriously mixed signals, this weird, unsettling calm that feels like it could just shatter at any moment. So, let's try and decode what all this volatility really means for stocks, for oil, and yeah, for your wallet.
Right now, you could say the market is taking a breath, but it's a very, very shallow one. The initial panic selling seems to have stopped, which is good. But the tension, you can almost feel it in the air. It seems like instability is just the name of the game for now. The market has officially shifted into wait-and-see mode. It's kind of caught between two feelings, right? On one hand, there's relief that the absolute worst-case scenario hasn't happened, at least not yet. But on the other hand, there's this deep anxiety about what could be just around the corner. Everyone's looking for a sign, any clear direction. But for now, we're all just holding our breath. So let's start by taking the market's pulse. How do we actually measure this collective feeling of anxiety? Well, lucky for us, we have a tool for that, and it is telling us a pretty fascinating story. Okay, let's look at the VIX, what everyone calls the market's fear gauge. The best way to think about it is like a heart rate monitor for Wall Street. And right now, that heart rate is definitely elevated. It's up more than 10%. So what does that tell us? It tells us investors are nervous, for sure, but they're not in a full-blown heads for the exits panic yet. Now let's zoom in on the stock market itself, because it is showing a true split personality right now. I mean, some parts are holding up surprisingly well, while others are really feeling the heat. And you can see this split right here. The broader market, represented by the S&P 500, is down. But then you look at tech, and it's a totally different story. A giant like NVIDIA is actually bouncing back, up 3%. So why the difference? Well, investors might be thinking that tech is a bit more shielded from the real-world, physical supply chain problems that could hit other industries. It's a real tug-of-war between the tangible economy and the digital one. That really is the key question, isn't it? What on earth is pulling the market in two different directions at the exact same time? Well, the answer seems to be in two conflicting economic signals that just dropped. So first, the good news. The ISM Manufacturing Index just came in at 52.4. Now, all you need to know is that anything over 50 means expansion, that the economy is growing. In normal times, this would be a clear, flashing green light for stocks. But there's a catch. And here is the catch. Buried inside that same exact report is the price component, and it came in at a blistering 70.5. That, my friends, is a massive red flag for inflation. The market saw that number, got completely spooked, and what happened? Bond yields shot up, which puts pressure right back on stocks. All right, now let's turn to the absolute epicenter of this crisis, oil. What's happening in the Middle East is having a direct, and I mean dramatic, impact on one of the world's most critical energy choke points. Just look at these numbers. They're staggering. Tanker traffic through the Strait of Hormuz has collapsed. It's down by 70%. You've got over 150 ships just sitting there, parked in the water, waiting. This isn't some potential problem down the road. This is a massive, real-time bottleneck happening in the world's energy supply right now. And that bottleneck? It leads directly to this number. Brent crude oil is now trading around $82 a barrel. Now, it's pulled back just a little from its recent peak, but it's still a full 13% higher than it was before this all started. And that increase, that's basically a direct tax on the entire global economy. But this kind of uncertainty doesn't mean everyone is losing. This so-called geopolitical risk premium is directly boosting the stock prices of energy giants like Exxon and Chevron. And it's no surprise the defense sector is also seeing some green as investors start betting on rising global tensions. So with all this nervousness in the traditional markets, where are investors running to for safety? Well, the answer is a mix of the classic safe havens and one very popular digital contender. Gold just recently smashed its all-time high, and right now it's just kind of catching its breath. But don't mistake this little pause for weakness. This sideways movement, this consolidation, it tells us that the demand for safe assets is still incredibly strong. Investors are buying gold, and they're digging in for the long haul. At the same time, Bitcoin is facing a really critical test. After a pretty sharp drop down to $66,000, it has clawed its way back up to this key resistance level of $69,000. Seriously, how it behaves right here is going to tell us a lot about the wider appetite for risk among investors. If it can break above this level, that could be a really bullish sign. But if it fails, we could be in for more pain ahead.
Okay, so that's the lay of the land. It's a lot, I know. Let's zoom back out for a second and give you a simple guide. What you should be watching for as the market tries to figure out its next move. Keep it simple. There are 3 key signals to watch closely today. First, the ISM services data comes out. Will it fan those inflation flames even more? Second, keep an eye on 10-year Treasury yields. If they cross that 4.7% mark, you can probably expect more pressure on stocks, especially tech. And finally, watch the news out of the Hormuz Strait. Any development there, good or bad, could swing oil prices in a heartbeat. Look, if there's one sentence that sums up the entire market right now, it's this one. Geopolitics is in command, fundamentals are waiting. All that classic economic data we usually obsess over, it's just taking a back seat for now. Right now, everything is being driven by global tensions, period. And that leaves us all with one final and I think really crucial thought. For a long time, a lot of investors could kind of get away with ignoring geopolitics. But as we're seeing play out in real time, maybe that's fundamentally changed. The biggest question for all of us might be this. In this new era, is geopolitical risk now a permanent, unignorable factor in every single investment decision we make?